Let's bring in Nancy Davis, founder and chief investment officer at Quadratic Capital Management. Nancy, great to have you with us. And I'm wondering what your take is on some of the moves we've seen in the bond market of late. And I'm thinking really of the move that we saw recently from 3.4, which is a recent low, the first week of December, so second week of December, back up to 3.9 in pretty short order on the 10-year yield.
Yeah, definitely. The U.S. yield curve is still one of the most inverted it's ever been, even lower than it was in the late 80s. And so I think as the market goes, potentially, this is one of the most widely predicted recessions we've ever had, at least in my career history. I think the yield curve could really normalize in a more stable environment because so many people are expecting, they're hiding in 10-year bonds, and you could expect people would maybe asset allocate away from the 10-year treasury into more risky assets, and that would help normalize the yield curve.
With every major central bank now moving towards higher rates, including finally Japan, Nancy, I'm wondering if we should brace ourselves for even more upside on the 10-year yield and what levels you might expect.
Well, I think Japan widening the band on yield curve control is a really positive step. The market was not expecting that until after Kuroda stepped down after Japanese New Year. So it was a great surprise to have it happen in the month of December. I think it is another sign that we could see more normal bond markets. Right now is not normal, where you can get paid more yield to own a T-bill than you can a long-dated treasury. And so I think Japan easing off and widening the band on their yield curve control is a healthy sign. At the end of the day, lenders lend money, and when long-term interest rates are lower than short-term interest rates, there's not a big incentive to extend credit. And so it's always a chicken or egg. Which comes first? Does the inverted yield curve predict the recession, or does it cause a recession? No one really knows for sure, but I do think it's a healthy sign that Japan has at least moved an inch closer to the rest of the hawkish central banks.
Or maybe is it a good predictor or at all, because the distortions, and that was a conversation I was having with Mark Zandi the other night. He thinks the stock market is in a better place, and that is the better indicator at this point. And of course, he's an economist, and you rarely hear that from an economist, that the bond market is distorted to the point where you cannot take what it is telegraphing to heart too much.
There is a lot of leverage in the bond market. We saw that with the UK, with the LDI managers. So they're using leverage because we've been in, really since the financial crisis, a period of such low yields for way too long that investors have added more risk in their bond portfolios and used those government bonds as collateral for other risky investments. So it's almost like pulling a string or a piece of yarn on a sweater. And, we definitely don't want the whole thing to unravel, but there is a lot of leverage in the system and also a lot of move on the institutional portfolio side to illiquid investments, whether it's private credit, direct lending, private equity. All of these asset classes do not have a lot of liquidity. And so it's probably going to mean more liquidity moves, more bigger volatility moves in the public markets like government bonds around the world.